Imagine you owned a piece of the most powerful company on Earth. Not Amazon, not Apple, not even close. This company had its own army, its own navy, its own private prisons. It held a legal monopoly over the trade of an entire ocean. At its peak, it was worth more than the GDP of most modern nations combined. And ordinary people, blacksmiths, clergymen, widows, were pouring their life savings into it. Then, in a single afternoon in 1720, it collapsed. And the world had no idea what had just happened, because nothing like it had ever happened before. This is the story of the first stock market crash in history, and the mechanics behind it are more familiar than they should be. Let's go back to the beginning, not 1720. Further, the Dutch East India Company, the VOC, needs to fund a voyage to Asia. These weren't pleasure cruises. They were multi-year expeditions through hostile waters, and they were extraordinarily expensive. The problem was that a single merchant couldn't afford to fund one alone, and if the ship sank, he was ruined. So someone had a remarkably clever idea. What if you split the cost and the risk among hundreds of people? Each person buys a small piece of the voyage. If the ship comes back loaded with spices and silk, everyone profits proportionally. If it sinks, no one person is destroyed. That idea, fractional ownership of a future profit, is the stock. And within a decade, Amsterdam had built the world's first formal stock exchange to trade them. It worked brilliantly. The Dutch Golden Age was, in large part, funded by this mechanism. Capital flowed, companies expanded, wealth multiplied. But here's where it gets interesting. The thing about a working idea is that it attracts imitators, and imitators attract people who understand the shape of the idea, but not its substance. Fast forward to London, 1711. Britain is broke. The War of the Spanish Succession has left the government drowning in debt, roughly 10 million pounds of it, owed to thousands of individual creditors. The government can't pay it back, so a politician named Robert Harley proposes something creative. He offers those creditors a deal. Hand over your government debt, the IOUs you're holding, and we'll give you shares in a brand new company, the South Sea Company. The company's stated purpose was to trade with Spanish colonies in South America. Slaves, mostly, but also goods. The presumption, and it really was just a presumption, was that Spain would open its ports, Britain would flood in, and profits would cascade back to shareholders. There was one problem. Spain had no intention of opening its ports. The actual trading rights Britain received were extremely limited. One ship per year, that's it. One ship. But the prospectus didn't really dwell on that. What it did have was the implicit backing of the British government, and in 1720, the company proposed a second act. It would absorb the entire British national debt, all of it, in exchange for more shares, more investors, more capital. Parliament approved it. The king became a shareholder. His mistresses became shareholders. Members of Parliament became shareholders. Some of them bribed directly with company stock before they voted. The share price in January 1720 was £128. By June, it was over 1,000. Now, here's where you have to understand what was actually happening, because this is the part that gets lost. The South Sea Company wasn't really a trading company at this point. It was a financial instrument. Its actual business, that one ship, was almost irrelevant. What it was selling was the idea of future wealth, the expectation of profits that didn't yet exist, and in many cases, never would. Investors weren't buying a piece of a company. They were buying a piece of a story, and the company knew this. So, to keep the story credible, they needed the share price to keep rising. A rising share price attracted new investors. New investors drove the price higher. A higher price made the original investors look smart, which attracted more new investors. You recognize this. Everyone does. But in 1720, nobody had a word for it. To make it even more seductive, the company began offering installment plans. You could buy shares with a small down payment and pay the rest later. This meant people could bet money they didn't have on a price they couldn't justify. London lost its mind. New companies appeared overnight, floated on nothing, selling shares in schemes that ranged from the ambitious to the openly absurd. One prospectus, often cited, allegedly offered shares in a company for carrying out an undertaking of great advantage, but nobody to know what it is. The founder reportedly raised £2,000 in a single morning, then disappeared. This period became known as the Bubble Act. Actually, that's not quite right. The Bubble Act was Parliament's attempt to pop all those smaller bubble companies to drive investors back towards South Sea, which worked for about 6 weeks. Then, in August 1720, a few of the company's own directors started selling quietly, strategically. They knew what the books looked like. They knew the trading revenues were negligible. They knew the share price was a collective hallucination. hallucination, so they got out. But markets notice things. When insiders sell, someone notices. Confidence is a strange substance. It builds slowly and evaporates instantly. By September, the share price had started sliding. Investors who had borrowed to buy began receiving margin calls. To pay those calls, they sold shares. Selling drove the price lower. Lower prices triggered more margin calls. The feedback loop that had driven prices up was now running in reverse. By December, the share price was back near £100, a near total collapse. People who had borrowed against their holdings to buy homes or fund businesses or pay off old debts, they were wiped out. Not inconvenienced, destroyed. Isaac Newton, who had sold his South Sea shares early and made a tidy profit, watched the mania from the sidelines, then bought back in near the top. He lost the equivalent of about $3 million in modern terms. He reportedly said afterward that he could calculate the motion of the heavenly bodies, but not the madness of people. The fallout reshaped British finance for a century. Parliament banned the formation of joint stock companies without a royal charter for over 100 years. The Bubble Act of 1720, meant to protect the South Sea Company, ended up becoming a regulatory straitjacket that historians argue slowed British industrial development for generations. The men who engineered the scheme were investigated by Parliament. Some fled the country. One director was found to have assets of £183,000, an almost incomprehensible sum. Parliament confiscated most of it. The company's cashier managed to escape to France with a large portion of the books, which may or may not have been intentional. Robert Walpole, who had been skeptical of the scheme and had sold early, emerged from the wreckage as the dominant political figure in Britain. He became what many consider Britain's first prime minister, partly on the basis of having been correct in a room full of deluded optimists, which is historically a very good career move. Now, zoom out, because here is what actually happened in 1720. For the first time in history, you had a widely distributed financial instrument, shares, that were priced not on the underlying business, but on collective belief in a future that hadn't arrived. You had leverage, borrowed money amplifying both the upside and the collapse. You had insiders with an information advantage making decisions that were legally ambiguous. You had regulators who were also investors. And you had ordinary people with no framework for evaluating any of this, making decisions based on what their neighbors were doing. The South Sea bubble wasn't an anomaly, it was a prototype. The Dutch tulip mania preceded it. The Mississippi Company in France, a nearly identical scheme run simultaneously by a Scottish gambler named John Law, collapsed at almost exactly the same moment. The mechanics reappear in the railroad booms of the 1840s, the Florida land rush of the 1920s, the dot-com bubble, the housing crisis of 2008, and the asset classes you're watching right now. The instruments change, the jargon changes, the marketing language gets more sophisticated. The underlying structure does not. Here is the question worth sitting with. After 1720, after the investigations and the collapsed fortunes and the new laws and the cautionary tales, after all of that, the system didn't disappear. It evolved. The stock market came back, joint stock companies came back, leverage came back, and within a generation, they were bigger than before, because the mechanism, when it's not being used to inflate a fiction, actually does something useful. It pools capital, it distributes risk, it funds things that one person couldn't build alone. The question is whether we actually ever learn to tell the difference between the ship that's coming back and the one that never was built. In 1720, people couldn't. 300 years of practice later, it's worth asking if we're any better at it.